All right, let's jump right into this explainer. We're looking at a truly fascinating anomaly today, trying to decode the incredibly complex and honestly kind of contradictory narratives around a historic US delegation to Beijing. Now, you've probably seen the headlines, but the sources we're digging into today suggest that what actually happened there goes way, way deeper than your standard diplomatic grip and grin. We're going to break down the geopolitics, the economics, and this really wild financial theory to figure out what it all actually means. Okay, let's dive into this. Seriously, why are 18 of the absolute leaders of America's industrial core sitting across from Xi Jinping? I mean, just imagine the private jet traffic jam in Beijing for a second. But here's the thing, when a country's leadership travels, who they bring tells you exactly what they need. This was definitely not just a diplomatic courtesy call. Just look at this roster. We've got Elon Musk of Tesla, Tim Cook of Apple, Jensen Huang of NVIDIA, Steven Schwartzman of Blackstone, and Kelly Ortberg of Boeing. According to our sources, seeing this specific group of heavyweights together is a symptom of a much deeper need. It's like looking at an iceberg, right? The speeches, the handshakes, that's just the tip. The real massive shifts are happening totally out of sight beneath the water.
Part 1. A shift in global leverage.
And this brilliantly illustrates what's beneath the surface. We have to step away from the diplomatic summit for a second and look at the physical space of global supply chains. Take the Strait of Hormuz, absolutely one of the world's most critical energy choke points. Just look at these transit insurance costs reported by our sources. Insuring a single voyage for a massive crude carrier linked to the United States, you're looking at an astronomical $10 to $14 million. But a tanker linked to Chinese or Iranian interests, roughly $800,000 to maybe $1.4 million. The American flag has literally become a financial liability out there, creating this insane 10-to-1 toxicity multiplier. And because the London insurance market effectively closed the strait to U.S. ships by pricing them completely out, well, the U.S. government had to step in. So now the American taxpayer is exposed to a massive $40 billion reinsurance bill just to backstop these routes. Our sources really hammer this home. American naval supremacy operates in physical space, aircraft carriers, destroyers. But insurance? That operates in financial space. And right now, the financial space is shutting down supply lines way more effectively than any physical blockade ever could. Which brings us right back to why the CEO of Boeing was on that plane to Beijing. If we just follow the money, Boeing's defense unit has been bleeding cash on fixed-price military contracts. To absorb those losses and literally keep their factories open, Boeing desperately needs massive commercial jet orders. Why? Because those commercial revenues fund the industrial base, which in turn builds the defense planes that maintain the U.S. nuclear triad and overall air supremacy. And here's the kicker. For nearly a decade, China hadn't placed a major order. So when we hear that China is negotiating these huge commercial jet purchases, we have to look at it through that specific lens. As one of our sources powerfully puts it, the purchase itself is a weapon, a kill switch. China isn't just doing Boeing a favor here. They are very calculatedly buying leverage over America's premier defense contractor. If they decide to turn off the tab, the U.S. defense industrial pipeline essentially seizes up. Part 2. The illusion of victory. Now, what's really interesting about this is, was the summit actually a resounding success? If we peel back another layer of that iceberg, the stark reality of the Boeing deal tells a pretty different story. Initially, expectations were sky high. Estimates were that China would buy around 500 Boeing jets. The actual announced order, just 200. This huge contrast visually undercuts that whole narrative of a massive diplomatic victory. In fact, it actually caused Boeing's stock to drop right after the announcement. Now, there were other agreements announced at the summit, things like restoring $17 billion in agriculture access, starting up talks on rare earth minerals, and easing those export restrictions on NVIDIA's H200 AI chips. But if you look closely, these quote-unquote wins are largely just reversals of previous trade and tech war policies that kind of backfired. China is simply removing restrictions they originally put in place as retaliation. So we're essentially just returning to the pre-2018 baseline. We're not exactly breaking new ground here. And that leverage imbalance, it remains profound. Just look at the proposed $1.2 trillion Golden Dome missile defense system. The U.S. is basically trying to build this massive vertical fortress. But to build it, you need huge amounts of rare earth minerals. Where are they found? Places like Greenland. But who controls the processing of those minerals? China. America's trying to compensate for a loss of leverage by building these incredibly expensive fortresses, but it's increasingly struggling to afford them, let alone secure the independent supply chains needed to actually build them. Part 3.
The Plaza Accord theory.
So if the surface-level trade deals were basically a stalemate, what were those 18 CEOs actually doing in Beijing? Well, now we're entering the really deep currents driving this whole event. Have you ever heard of the Plaza Accord? Back in 1985, the US had a massive trade deficit and a dollar that was way too strong. So they held this secret meeting at the Plaza Hotel in New York and agreed to artificially weaken the US dollar, particularly against the Japanese yen. It absolutely saved US manufacturing, sure, but the yen doubled in value so fast that Japan had to flood its economy with cheap money. That created an explosive asset bubble that directly led to Japan's infamous 30-year lost decade.
Okay, so some financial theorists believe we are actively witnessing negotiations for a Plaza Accord 2.0. The U.S. desperately needs a weaker dollar to manage its debt, and it wants a reported $1 trillion of Chinese investment to rebuild American factories. But China knows their history. They're flat out refusing to let their currency, the yuan, get revalued and destroyed the same way Japan's yen was. So what does this mean? It means if a deal is going to happen at all, it requires a completely different escape valve to reprice the global system.
Part 4. Gold and the New Order.
Let's move on and see how this builds, because if they can't revalue the currency directly, what do they use? Well, it turns out there is a massive, mind-blowing discrepancy hiding right in plain sight. The U.S. government holds over 8,000 tons of gold. But on the official books, it's valued at just $42 an ounce, a price that was set way back in 1973. Meanwhile, the actual market value today is over $45,000 an ounce. If the U.S. were to market gold to the actual current market price, it would instantly and dramatically improve its heavily indebted balance sheet.
And here is where it gets even more fascinating. Right now, the U.S. is the world's largest exporter of non-monetary physical gold, and a vast majority of it is heading straight to China. Historically, there's a pretty reliable rule of thumb. The country exporting gold is losing the economic transition, and the country importing it is winning. This massive migration of physical gold sets up the perfect framework for a coordinated global monetary reset.
Under this hypothetical win-win theory, both superpowers could actually walk away from the table claiming victory. Think about it. The dollar devalues against gold, which effectively inflates away massive amounts of real U.S. debt. At the exact same time, China's newly accumulated gold reserves completely skyrocket in value, making them significantly wealthier without hurting their export currency. Then, Chinese capital flows in to rebuild the U.S. industrial base, and in return, China secures vital access to U.S. consumer markets. It's basically a highly synchronized monetary reset.
Part 5. What this means for you. Now, I know geopolitics and trillion-dollar currency resets can feel incredibly abstract, but we really need to bring this back to your daily life. To execute this kind of global transition and manage unpayable debt, governments rely on deliberate inflation. And this creates what economists call a K-shaped economy. Imagine the letter K. It's an economic fracture where society literally splits. One group's wealth accelerates rapidly upwards, that's the top line of the K, while another group's purchasing power sharply and painfully declines, the bottom line.
So the absolutely crucial point here is this. Geopolitics isn't just about aircraft carriers or CEOs flying around on private jets. It is about the very real, everyday divide between owning assets and holding cash. If you hold assets, things like real estate, gold, or stocks, inflation actually makes your nominal net worth go up. You're protected. But if your wealth is just sitting in cash, or you rely solely on wages that simply cannot keep up with soaring grocery and energy prices, you lose your purchasing power. As the balance of global leverage shifts, and the underlying rules of money are potentially rewritten to accommodate this entirely new world order, it leaves us with a pretty critical question to ponder. Which side of the monetary shift are you prepared for? Because understanding these deep currents isn't just about understanding the world, it's about protecting your own future within it. Thanks for joining me for this explainer. Keep learning, and I'll see you next time.